right, well, 5 minutes in, and I'm finally getting hooked up today. Sorry for the delay here. Um, for those of you that could join, thank you very much. And for those of you who join the recorded version later, please do put your comments into the comment fields or email me. Uh, Basically, we're going to go through the mechanics of creating a discounted cash flow model. The idea here is that yeah, we can do them very easily with LLMs, whether it's Perplexity, Claude, or Chat GPT. Um, but they can be just as wrong as the ones that you read on your favorite brokerage account. And we'll talk about why they can be wrong and what you should do to try to help reduce the risk that you're going to end up putting your money into risky things just because he said it was a good investment. All right, so by the end of today, you'll be able to understand the breakdown or the anatomy of a discounted cash flow model. And they're called models for a reason, right? People do their best to build what they believe is a real world simulation of how a company is going to do in the future. Uh, but the simple fact of the matter is they are built on one assumption after another. And if you're not careful with your assumptions, you can be billions of dollars off, as demonstrated by ARK Invest models for Tesla over the years. And we'll show you, you can be able to run a basic DCF yourself, run the cash flow calculation using a short horizon cash flow projection and a stated discount rate for a single company, laid out in a structured spreadsheet model. This is similar to how you would do it if you were in an MBA class taking valuation. Though in the MBA class, you'd be making your assumptions for a 10-year forecast and then trying to pick what you believe a reasonable terminal rate would be. And terminal rate is your assumption of how fast the company or how slow the company is going to grow from now to eternity. Not a simple thing to guesstimate, and basically can make your model be totally wrong or very interesting to say the least, right? So the core idea of a DCF, so why a business is worth its future cash and it's discounted back today. So what the business is worth in future cash. The 5 building blocks: free cash flow, the discount rate, terminal value, present value mechanics, and the model structure. It'll be about 30 minutes that we'll go through that. And then we'll walk through an example of building the DCF, so a single company short horizon and a structured spreadsheet. And we can have AI assist, in this class or this recording. I'm suggesting that we use Perplexity just because it's one of the models that I don't see used as often. So I figure people might be interested in it, but you could just as easily use Claude or Chat GPT or Grok or Gemini. And we'll talk about some of the pitfalls and takeaways. And there are many. This is not a short circuit approach to just being able to do lots of things mindlessly. If you do it mindlessly, you'll end up regretting it later. Right, so here we want you to understand how you make up a DCF model and what each piece of it does and how they connect. So the core idea. So what's the company worth based on the cash it will produce? So a discounted cash flow estimates the intrinsic value, which is the present value of every dollar of free cash flow a business is expected to generate, discounted back to today. Cash that arrives later is worth less No. So we shrink it. And one of the mottos from my company, we have, follow the cash, not the noise, right? So earnings can be shaped by accounting policies. Cash is harder to fake. So, which is why the DCS starts here. And this just shows you, over the years, what 92 cents is worth, discounted at a 9% discount rate. So after 5 years at 9%, 92 cents is only worth 47 cents, right? So the world changes quickly when it comes to money. So the five building blocks, we have forecast of free cash flow, which is no simple thing to do. I don't know about you, but how often are you in a position to be able to make a good estimate of how much free cash flow a company is going to make? I mean, the hint is we can look at the filings that they've already generated and be able to make educated guesses. But what happens if you are not a public company and you're trying to do this for your own? It gets a little bit more challenging. And the discount rate, this is the return required to compensate for time and risk, right? And then we have terminal value. It's everything beyond the explicit forecast window. So if you're doing a 10-year DCF, so you'd be estimating for 9 years out, and the 10th year forward, you'd end up having some what you call terminal value. And then you have present value mechanics. So the fourth part of the model is you shrink each future cash flow back to today's dollars. And then the fifth thing is try to understand how your assumptions flow through drivers to the valuation. So by looking at each piece, we should be able to understand how our long-term estimate is shaped by whatever assumptions that we make in our model. And a good practice would be is you don't do just one of these and come out with one single point. You change some of your assumptions such that you can have a range and basically say, okay, well, if the economy shapes out for the business like this, the value is X, and if the very optimistic range, it's Y. So here's our range of potential values. So free cash flow is the cash a business has left over after it pays to operate and to reinvest. It's what owners could actually take out, the raw material of value. So as Warren Buffett would always say, if a company isn't reinvesting, it's probably not a company that you want to invest in. Basically, if people are just trying to run a company dry, it's not going to be a great long-term investment. You got to keep putting things back in for your resources, right? So you start with your operating cash flow, subtract capital expenditures, and then project a short horizon. So this will be 5 years using a growth assumption. And beginner rule, keep growth modest and defensible, not heroic, right? So most companies don't end up growing as fast as they think they will. And especially, entrepreneurs always come in with business plans where their growth rates are huge. And then, if you've got a good company, an interesting new technology, you might have a huge growth rate to begin with, but it usually will revert to the mean. Never seen one that didn't over time, right? So free cash flow over time. So free cash flow T-1 times 1 plus the growth rate. And G is your assumed annual growth rate of your cash flow. So our discount rate. So the discount rate is the annual return an investor demands for two things. One is waiting, and two is uncertainty and risk. No investor puts in their money without expecting to get more money back. And the higher the risk, the higher the discount rate. it's a higher risk or less predictable cash, you're going to have a higher rate, lower present value. Be explicit that advanced courses derive this from WACC, so weighted average cost of capital, right? So we're just giving you this, the R for this class to make it simple. But if you take a class like this in a university, you'll be hearing this term WACC, or weighted average cost of capital. So you can't forecast forever, and that's where terminal value comes in. It captures every cash flow beyond your explicit window. It's collapsed to a single number at the end of the forecast. And the Gordon growth method assumes cash grows at a slow perpetual rate. Terminal growth, G, should be low, at or below long-run GDP. So GDP is gross domestic product. So if your country in the long run has been growing at 3.5% to 4%, your terminal growth, your G, should be probably a little bit below 3% for terminal. And then TV is discounted back like any other future cash flow. So this is the actual arithmetic of discounting, right? You turn future dollars into today's dollars, divide each cash flow by 1 plus R, raised to the number of years. The further out the cash, the smaller the present value. The denominator is the discount factor. So use the chart at 10% a year minus 1. Cash is worth about 91 cents. Year 5, it's about 62 cents. And it keeps decaying. If the room is comfortable, we would end up just factoring this repeated division. Right? Slide through. Computer isn't taking my verbal instruction to forward the slides. So anyway, here we have the model structure. A good model makes its logic visible. The assumptions feed drivers. Drivers produce cash flows, and the cash flows roll up to a value. Change one assumption, and the output should update cleanly and traceably. So your model is all about assumptions. And this is one reason why I caution people about just going and reading a few valuations that you can get on Schwab or Merrill Lynch or E-Trade or any of them. They all seem to publish them, but how often do you understand all the assumptions that the various analysts put into it? When I was in school, Professor DeModern in the first class, he would tell people, when you're doing your models, remember, it's your story, stick to it. When I first heard that, I was kind of put back because it sounded to me like, boy, you can make any assumptions you like as long as you make your lies grand enough for the model to fit. And it's not what he meant, but basically, I guess what he did, I believe, intend to say is if you're making these assumptions, you don't change halfway through. You need to build a model that can prove those assumptions out. And most people probably do have a hypothesis to begin with, and they do build their models out first. Probably a better approach would be is not go into it thinking that the company is worth X or Y, and build the model and not be wed to a valuation. And that way you'll come up with a more honest approach. So the drivers are the formulas that turn assumptions into each year's projected cash flow. And then the valuation output is the present value of the cash flows plus the present value of terminal value. And that's what they call the intrinsic value. All right, so we want you now to take a few minutes, and we're going to build a basic DCF for a single company, a short horizon. And along, if learners are following along, this is the time when you would open up a spreadsheet. And then walk this table left to right, one row at a time. Start with the assumption strip. And then base the free cash flow to 120 million. 8% growth, 10% discount, 3% terminal growth. And we want you to show each year's cash flow growing, the discount factor shrinking, and the present value column. So then the terminal value row is discounted back at the year 5. Result at roughly 2 billion of intrinsic value, and point out it's just the sum of the yearly present values plus the discounted terminal value. The same recipe every time. So really the real skill is sourcing the believable inputs, which is the next slide, right? So these are all numbers that who's going to be able to argue with you? They're either going, either right, wrong, or way right or way wrong. Basically it's coming up with believable assumptions. So you got to lay it out so anyone can follow it, because these models are for probably, if you're doing it for yourself as an investor, they're for you, but they're also for anyone who you're trying to get feedback about your investment hypothesis, right? So you start with your hypothesis, the base year free cash flow, the growth rate, the discount rate, and terminal growth. So here's your assumptions. And at some point, you'll end up putting some narratives around why you have, growth at a certain amount and free cash flow at a certain amount. Then you have your projection. So one column per year, the discount factor row, the free cash flow row, and the present value row. And then you finally get to valuation. You have the sum of your yearly present values. You have your terminal value plus its present value. And you add for intrinsic value and then compare it versus the price. So this directly satisfies the structured spreadsheet model of the objective. And so if people have questions, email me. These are things that, this is a very simple example, but it's important that you understand the mechanics so you can be able to pull this into a more complex, realistic example. All right, so if you want to source your inputs with Perplexity, so the DCF is only as good as its inputs. Use Perplexity to gather them fast and verify them against a filing. Treat AI answers as leads, not citations, right? So you want to, these in the little white rectangles, you can put those sentences are right into the prompt of the chat. All right, list your tickers, operating cash flow, and CapEx for the last 5 fiscal years with the 10K sources for each. Perplexity should do a pretty good job of bringing back that data for any publicly traded firm. Then as the analyst, it's your job to look at the sources and verify that there wasn't a hallucination or a misreading. And Perplexity is getting better, but it was a little bit famous for hallucinating. I guess all the LLMs had some problems with hallucinations. So the real key is to ask the LLM to cite your sources. I asked to cite in the form of a URL, so I can go in there and click on the URLs and quickly look to make sure that the content that it's referencing actually is the fact that I wanted it to. Then you can ask it, what free cash flow growth rate have analysts assumed for this ticker? So now you can look to see, okay, is the growth rate that I have in my DCF, is it realistic based on what real world people are doing for this company? And then you want to summarize the risks that could change the ticker's cash generation over the next 5 years, and ask the Perplexity to source where, cite the sources. They should be able to get these things right out of the SEC filings. And Perplexity does a good job searching the web as well. Right, so open the primary source Perplexity links to and confirm the number. Pull the cash figures from the cash flow statement and log where every input came from. Your model should be auditable, right? So if a figure can't be sourced, don't use it. It can be pretty embarrassing if you publish these things and then the world turns around on you and says, hey, what's up with that? That was definitely wrong. Right, cite or verify discipline for all LLMs. Here's some examples of things that ended up being pretty embarrassing for people. In June 2023, a New York attorney named Stephen Schwartz filed a 10-page legal brief and a routine personal injury case against an airline. Schwartz had been practicing law for 30 years. To save research time, he asked ChatGPT to find supporting case law for the arguments. ChatGPT delivered. It gave him 6 cases with full citations. He thought it was his lucky day. Case names, docket numbers, courts, judges, page numbers. He copied them all into his brief and filed it. There was just one problem. None of the cases existed. ChatGPT had fabricated all 6. That was pretty embarrassing, right? Especially for a lawyer. Opposing counsel couldn't find any of them, neither could the judge. So the judge ordered Schwartz to produce copies of the opinions he had cited. And here's the part that lives forever. Schwartz went back to ChatGPT, asked it whether the cases were real. ChatGPT said yes. He asked for the full text. ChatGPT generated plausible looking opinions. Schwartz filed those as exhibits, screenshots of ChatGPT confirmation of its own hallucination as proof that the cases were real. And needless to say, they weren't real. So where DCFs go wrong, garbage in, garbage out, right? So if you have unrealistic growth rate, you're going to get a ridiculous DCF. Terminal value, just a 1% difference in terminal value because it's going for infinity is huge, right? Discount rate sensibility, right? A 1-point change in R can swing a value double digits. Always test the range. And then false precision. So a DCF is a reasoned estimate. It's a reasoned estimate. It's not a price target. Use ranges. Right, so basically anyone who's telling you that this is coming up with my expected price, you see like in Yahoo Finance, you can see that the expected price, target price of X dollars over the next year. Well, I'm sure that isn't for just one estimate. It's probably the average of all the analysts that they've surveyed. And here's some example. ARK Invest open sources their valuation models. So you can go out to GitHub, excuse me, and look. They've got them for many years of what they've used for their models, and they're pretty famous for having some pretty very large numbers for whether it's Bitcoin or Tesla, and I'm sure that they will have similarly large ones for SpaceX. And basically remember that a broken clock is right twice a day. And what you'll see when you look at ARK Invest GitHub library, they will keep redoing, as long as the company stays in business, they keep updating their estimates. But you can see that even the people that are probably some of the best at doing this are usually not very accurate. But if you're going to be building these things, you should go out and take a look at it. So since we've had no questions today, we've gone through this pretty quick. So a recap against the objections. So Basically, we want to understand, name, and explain the 5 building blocks. You want to be able to build a basic DCF for one company, and you want to be able to gather the inputs with Perplexity and verify them. Right? And again, I think that this is something that everyone is going to be good with, but please do. I enjoy getting questions. I taught for a number of years and would tell my students that so that I don't sound like Charlie Brown's teacher, blah, 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 blah. It'd be great if you ask me a few questions and keep things interesting. And just my legal disclosures, this material is educational and for general information only. It's not investment, financial, legal, or tax advice, and it's not a recommendation to buy or sell any security. The worked example, it uses hypothetical figures to illustrate the mechanics. A DCF is a model built on assumptions. Small changes in inputs can materially change the output. Always do your own research and consulting a licensed professional. Occam's Forensic Jury publishes general financial education under the publisher's exemption. No personalized advice is provided. And if we don't have any questions, I will close this off. Hopefully in the future, we'll start getting a few people to join.